we're financing every single dollar that we earn.
Yeah.
So even if you go pay cash for something, there's opportunity lost because you handed that dollar over to somebody else.
And it's gone forever.
And it's gone forever. You've lost the fact of a huge opportunity cost on that dollar for the rest of your life.
So you will never make interest on that dollar ever again.
No.
Like, it is out of your world.
Yes. So it is opportunity lost, and you just handed the opportunity now to earn interest on that dollar to somebody else. 34 cents of every dollar that people earn is paid in interest. That's not even including the taxes that we pay on that dollar. And so that's something that people need to start to realize is there's a reason why you can't get ahead on this thing. It's because we are financing every single dollar that we earn.
Hey there, and welcome to the New Agent Jumpstart podcast. My name is Colt Callison, and if this is your first time listening to content, normally this channel is all about, providing, great information for newer agents that are looking to go from starting out to $100,000 in their first year. So that's the content that's typically on here. Today, though, I'm shifting gears, and I got a very good friend of mine with me, and he got me started on this concept of building wealth using, kind of a unique strategy, and we'll get into that. But so this is going to be talking more about building wealth and preserving wealth and securing a future for not only yourself in retirement and also investments and everything like that. So I want to introduce Jason.emley. You and I have been friends for years.
It's been a while now.
And you are now, considered a wealth strategist. Mm-hmm. So I remember when you came to me, gosh, you tried to get me to do this for at least 2 years. And
yeah, probably. And I don't really even remember what brought up the conversation, but yeah, it had been a while.
Well, if I recall, it was when I was with Keller Williams, and I was talking about passive income and replacing your current income with passive income and becoming financially free, everything like that. You saw the Facebook post, reached out to me, and it's like, hey, we need to go to breakfast.
Yep.
And so I remember we went to, I think it was Jimmy's Egg.
Yep.
I got a free breakfast out of that, so thank you. We need to do that again. But no, it was great. And honestly, the concept that you brought up, I pushed back a lot because I came from the Dave Ramsey school of thinking. We're going to get into it, but whole life insurance, bad, buy term, invest the difference, everything like that. So that's what I was doing at the time. That's what I thought was the right way to go. And then after talking with you multiple times, and then the books, what I loved about what you did is you didn't just try to shove it down my throat. You said, hey, go read this book. Just keep an open mind, go read the book. So, and the book that you told me to read, the biggest one is Become Your Own Banker. So it was written by a gentleman who passed away a couple years ago. Great guy. I've watched a lot of his videos, R. Nelson Nash. And honestly, man, this thing, what is it, 90-some pages?
Yeah, super quick read.
Super quick.
If you're into it, you'll read it in no time.
Yeah, I read it in, I think, 2 days.
Yep.
And then I was like, hey, is this what you've been trying to tell me for the last 2 years? You're like, yep. Yep. So, no, I'm really excited that you're here and you come on the podcast to help people out. So I want to really dive into kind of what got you started down this path. And then, anything you want to share before we really dive into everything. So.
Well, I'll tell you, that's not unusual for a lot of people. The first conversation I have that kind of just push it off to the side because there are a lot of talking heads out there that are talking about another way to build wealth. And I followed that too, to be honest with you, before I came into contact with this way of thinking. But back in 2018 or so, I was looking at things, and for the amount of income that we were making at the time, I didn't have as much to show for it as what I thought we would at that point, being mid six-figure earners. And so for me personally, I thought if I keep doing this, I'm going to have the same results going forward. So something's got to change. And so it was the same way for me too. And it was, for me, it sounds funny, but it was a YouTube search. What are the wealthy doing with their money? And it wasn't even Becoming Your Own Banker was the first book that I actually found. Now it's the book that I share wholeheartedly.
Yeah.
There's two books I share. One's the first one I found, which is by Garrett Gunderson, called What Would the Rockefellers Do?
Good book.
That's the first book that I ran into. And you guys, I encourage you guys to find him too, because long-haired, gray, not your traditional, financial planner by
Wealth
any
Without Wall
means.
Street, right? Wealth
Wealth Without Wall
No,
Street's
that's-
another podcast that I'd recommend
true.
anybody and everybody listen to. I listened
What's
to
Garrett
two or three.
got? He's got a good podcast.
Well, so he had Wealth Factory when I first got
That's
started. Now he's kind of offshot a little bit more. He's actually doing some stand-up comedian type stuff when it comes to money now. Yeah, but that's the cool thing is he's built a life that provides him to do whatever he feels like he can bring a value to somebody else. And ultimately, that's what I want to work with my clients on is, let's take care of the financial side of things and allow you to really take whatever your value is and really bring value to other people with, in turn, build your wealth and everything as well, because you're doing what you're meant to do.
yeah.
But yeah, that simple, what are the wealthy doing with their money? And I found the book, What Would the Rockefellers Do? I read that. And at that point, I was hooked of wanting to continue to learn more and more and more. For us, it's unfortunate, but luckily I found the way of thinking. About 9-10 months later, we lost a big substantial part of our income. And so I wasn't looking to be a wealth strategist or a licensed life producer or anything like that. I was just, because the route that we were going was doing very well for us at the time, but things change. So luckily I found this way, realized that, hey, I've got some of these products already in place. Is there ways that I can start implementing some of these strategies? And so we started doing that. Well, when your income gets cut the way that it did for us, people started asking, like, you're not freaking out. What's going on? You should be freaking out. People that were in the same industry that we were in. And why are you not freaking out? And I said, well, hey, this is some of the moves that we've made. I've been looking into this for about the last year and a half or so. We've done some moves here, here, and here. This is what we've been doing. And so, I was helping people before really even being able to help them. And after about, the 8th, 9th, 10th person somewhere in there said, well, you're the one that's answering all my questions. You're the one that's telling my life agent how to do this. I want you to help me. And I said, well, legally I can't. I'm not licensed. I can't do this.
Yeah.
So that's ultimately what led me down this whole path of becoming a wealth strategist and finding the firm that I work with now and really diving into how are people really structuring these things out and building them from here on out.
Yeah. So, I remember when you and your wife were going through that transition period. Because you guys were very successful with what you were doing before.
We were, yeah.
And so, seeing what you guys have done since then has been truly awesome. And then, you stepping into our lives even after that and being like, hey, with what you're saying, our mindset is a lot alike.
Yep.
And you really need to start checking this out. And I'm so glad that you kept on me because, I've been doing real estate for 13 years, going on 13 years now. And, we got started in our first policy together, in April of 22, I think.
Yep.
We have it here, but, so that was basically 10 years into my career, always made 6 figures or more. And I had nothing to show for it.
Yep.
Just nothing. And no passive income or anything like that. And this, ever since that, my wealth, I've been tracking it, and it's just gone up. Yep. It's amazing. Then some of the things I've been able to do, this whole podcast studio was funded by this. So it's pretty cool,
Yep.
Of what you can do. So basically, the strategy that you brought to me and went completely against the grain on my way of thinking is doing what the Rockefellers have done. J.D. Rockefeller set up family trusts and everything, and securing his family's future and their wealth through whole life policies, right? And it's overvalued or overfunded, really, whole life policies. But they're not your typical whole life policies that 95% of these life insurance agents are selling.
Yep.
The Dave Ramsey whole life policy, I'll 100%, I'll give it to him, bad. Right, because in my mind, because it's 100% basically death benefit and very little cash value. So, we structure these a little bit differently. So take a minute or two and just kind of explain the vehicle that we're using and kind of why we use it that way.
Well, so the strategy that I teach my clients, and I look at me, if anything, I'm an educator and I'm a teacher more than anything with each one of my clients. And so the strategy that we're talking about is infinite banking. So it's the infinite banking concept, becoming your own banker, which is what Nelson Nash called it. Bank on yourself. There's a lot of different nuances out there where people will call this now, because really since 2020, this thing has really taken off, the thought process. People are starting to realize the way the world's changed since 2020. People are starting to realize, hey, the traditional way just isn't working.
Yeah.
And so the biggest thing is it is a concept, it's a thought process, it's a strategy, it's the way that we utilize money. It's not a product by any means. The concept would be a product plus the strategy, because you can go out and buy a whole life policy and structure it properly. But if you're not willing to put strategy behind it, use the cash value, leverage against this thing, you're just going to have that, a whole life policy. You're not going to get the full benefits that we teach our clients. And so that's the biggest maybe misconception that a lot of people have is, well, okay, I just go out and buy a whole life policy and now I'm doing the concept. Well, no, that's not it at all. It's the thought process of how we utilize money, how we keep the flow of money always going, how we can use the same dollar and actually earn a return in two different places at the same time, thus increasing the return that you are getting within your policy plus what you're getting in your investment. Another thing too is a lot of people, the misconception that a lot of people have is not understanding that we're financing every single dollar that we earn.
Yeah.
So even if you go pay cash for something, there's opportunity lost because you handed that dollar over to somebody else.
And it's gone forever.
And it's gone forever. You've lost the fact of a huge opportunity cost on that dollar for the rest of your life.
So you will never make interest on that dollar ever again.
No.
Like it is out of your world.
Yes. So it is opportunity lost, and you just handed the opportunity now to earn interest on that dollar to somebody else. Nelson Nash gets into his book about it. I bet it's even higher now, but he talks about 34 cents of every dollar that people earn is paid in interest. That's not even including the taxes that we pay on that dollar. And so that's something that people need to start to realize is there's a reason why you can't get ahead on this thing. It's because we are financing every single dollar that we earn.
And if you truly understand how financing works, especially like mortgages, right? 30-year mortgages, the first 7 years of a mortgage is mostly interest, right? And so that's why from the 5 to 7 year range, if you own a house, you're going to start getting bombarded with mailings and advertisements from lenders that want to refinance your loan because they know up until that point, you've paid almost only interest and they want to start that cycle all over again. So the volume of interest is just, it's huge. Yeah.
Huge. It's astronomical, the amount of interest that we pay.
And so if you can recoup all that, and I'm not saying, we bought our house through this. I mean, we want to eventually pay off our house and then make the payment back to us and everything and recoup all that interest that would be going out. But that it takes a while to build up what R. Nelson Nash calls your banking system.
Right? And each person's different in that regard. For some people, they can take over the complete financing in their life within 3, 4, 5 years. For some people, it may take 20, 25 years. Nelson Nash, I think it took over 20 years for him to be able to take over this whole function. So yeah, you would know also a little bit more about this, but how often somebody moves. So, I mean, if you moved within that 5 years, of paying all that interest, now you're just starting the cycle all over again.
For sure. I mean, it used to be 5 years ago, the numbers were about roughly every 7 years. Okay. And now, latest statistics, because of, we're not so stuck in people or where they're working, they're more, it's online now and all that remote working, right? So now people are moving to where they want to move or maybe they do have a job or a family situation. So now we're seeing things where they're moving every 3 to 5 years. So it's even quicker. And so if you think that first 3 years, it's almost all interest, almost all. So, I mean, the only people that are winning in that situation are mostly the banks.
So teaching my clients, friends, family, whoever it may be, that you can start taking over that banking function inside your life by using this strategy.
So and let's talk about that. Let's kind of give a real world example. So for us, we've been able to take over the banking function when it comes to our cars, right? And we got basically 2 brand new cars. I got my GMC Sierra AT4. It's been my dream truck for a few years. And then my wife just got her Yukon Denali, right? Both of them brand new. So I was typically against buying brand new cars, but we're recouping the interest and all that. So, a typical person would look at it. You could either finance a car or you could pay cash for the car. But there's a third option, right? And so that third option, what we did is we funded our banking system by overfunding whole life, right? And then we borrowed against the cash value from the insurance company because you're not utilizing your own money.
Correct.
And that's where I think Dave Ramsey missed the ball, right? He thinks, well, you're borrowing your own money. Why would you pay interest on your own money? Well, you're not. Your loan from the insurance company is collateralized against the cash value, which is, an early death benefit, in the policy. So you're just collateralizing against the cash value that you built up. The cool thing is my cash value is still growing if I borrow against it or not. So it's uninterrupted compound interest. So if I go and I have $50,000 sitting in the bank account, here at the local bank, and I say, okay, I want to take this $50,000 and go buy a vehicle. That's great. I bought a vehicle with cash, but now my money's no longer earning interest. And I'm missing out on that compound interest for the rest of my life. So that's why we really enjoy this, because we were able to fund our policies, which it took us a little bit of time to get that going and everything. And then we would collateralize, or we would take a loan against it by using the insurance company's money, and we'd go pay cash for the car. So we paid cash for the car. Now we can pay ourselves back the same payment that we would have paid a bank anyway. If you're willing to pay a bank and you're willing to pay them interest, why would you not pay yourself interest? And so we're just paying ourselves back. It keeps building our pool of money that we can borrow against, and we can go use it again. So, and then the cool thing is, once our car's paid off, we still have all this cash, and our cash never quit compounding in interest.
Exactly. And you can basically just recycle that same dollar over again. So in, let's say, 6 or 7 years, you're making a consistent payment back to that loan for the life insurance. Within 6 or 7 years, or however you want to structure that, we can get into that a little bit too, how repayments made and all of that. But you could do it in a year's time. You could do it over 10 years, however you wanted to do that.
So how is that structured?
Well, so
for people who don't know, because I know.
So
do I have to make a payment?
You do not. So this is a contract, and this is why I love this. So a policy is a contract between you and the insurance company. It is protected by contract law, which I absolutely love. And so it is a unilateral contract in regards to, if you pay premium, you are guaranteed to get a death benefit paid out at the time of your death, 100%. Okay. But with the way we structure these policies is we fund them with what's called a PUA, or a paid up additions rider, which gives you the ability of cash accessibility. It buys up additional paid up additions. It gives additional life insurance. But more importantly, for a lot of my clients, they're looking for cash value growth. They're wanting to use this for investments and those type of things. So what that PUA rider does is it gives the cash accessibility along with a death benefit. Okay. And so as long as you have the cash value present inside of that policy, you get to dictate what the terms are of paying that back. So every single one of my clients, though, I tell them and I teach them and show them that you need to be a good banker. That's the thought process behind this. We're doing this to be able to create a banking function within your life and be able to finance anything and everything you want to within your everyday life. So you want to be a good banker. However, those payback terms are your terms. They're not set by the insurance company. Much different than, I should say, than if you went to your local credit union or bank or hard money lender or whoever. They're the ones that are setting the payment restructure on this.
And God forbid you miss a payment.
If they say it's this amount of interest over this amount of years, and we all know that if you miss a payment a month or two or whatever it is, they're coming for that vehicle that you purchased with that. They're using that as the collateral against the loan. Well, here, the collateral against that loan is the cash value that you have inside that policy. Okay. So all you are responsible for is the interest earned on a given year or for the amount of time that you had that cash value borrowed against.
Yeah.
Okay.
So just to throw out a real world example, every time that I take a policy loan against my cash value, Emeritus, they charge me 4% annually.
Yes. And that's a flat
Flat,
interest as
yeah.
well, which it's not a compounding interest. It's a straight flat interest.
Yep.
That's a game changer too when you start thinking over the course of your life as well. But it is 4%. Each carrier is different. That's the great thing is as a non-captive agent, I'm not set by just being a New York Life agent there's nothing wrong against anybody that is a captive agent, but we get to shop around and find, because all these insurance companies, they're competing for market. And so, there's benefits to one, benefits to the other. You'd asked something about potentially asking about how to choose an agent. Well, those things are important because each individual client that I work with, their nuances, their thought process, what they're wanting to build out, what they're doing, loan provisions, all those type of things are different. And so one carrier may work for them better than another carrier. And so Emeritus is one of those that we use.
And something that is really important, every single insurance company that you work with is a mutually owned, it's not a stock market type insurance. So it's not like an Allstate or something that reports to stockholders, right?
Yep.
So they're not publicly traded companies. So they're not looking to make a profit for the stockholders. All the profit, well, not all of it, but most of the profit at the end of the year goes back to us as the policyholders because we are mutual owners in the company when we buy a policy, right?
Yep.
And then when they pay us a dividend based off our
The profitability of the company.
Correct.
Exactly. Yep.
Yeah.
Yep.
So that my money on cash value, it automatically has a guaranteed rate of return, right? And that's by contract.
Yes.
So it will not go down or up or anything. It's a guaranteed.
Regardless of what the markets do.
Correct.
Up or down, loss, gain, whatever it is, you're guaranteed a set amount of return.
Which is what I love. And this is not an investment. This is just, you're going to put your money somewhere, right? You're either going to get paid and you're going to go put your money in a bank, or you're going to hold it in a jar or something. You're going to put your money somewhere.
Yep.
So why not put it in your own banking system that, one, spins off a life insurance policy. So if something happens to you, your family's protected. It's protected by creditors. So, if I get sued, it's a private contract.
Yep.
So creditors can't go after it. It always goes up in value. So even and the longer it goes, the more efficient it is, right? So the more it grows because the compounding interest effect. But when everybody's freaking out with 401ks and IRAs and everything, and the market crashes, I'm over here because I don't have a dollar in any of that.
Yep.
And so my money just continues to grow.
Yeah. So what I tell people is when it comes to our savings should never go backwards. It's called savings for a reason. And so I think for a lot of people, they'll talk about their retirement savings in a 401k or traditional way using Wall Street. Okay. Is it really savings? I would argue no, because your savings should never go backwards.
Correct.
And what I tell people is there is an amount that you should pay yourself first, whatever that amount is. I have some clients that are saving a couple $100 a month, helping their kids get started with the policy. I have clients that are putting much more into a policy on a yearly basis. But they are paying themselves first, securing these funds with a guaranteed growth, and then they're using this as leverage to go out and take the risk out in whatever investment they're good at.
Yeah.
And so take the risk out there, but don't take it with your hard-earned money.
Yep.
Yep.
Yeah. I mean, Warren Buffett says, what is it? The two rules of money.
Yep.
Rule number one, don't lose money. Rule number two, see rule number one.
Yep.
So yeah. And that's why it's not an investment, right? Because investments can lose money.
Yes.
I mean, that's why it's a risk you got to take, right?
Yep.
So no matter if it's real estate investing, stock investing, we do REITs, which is basically a stock that pays off a monthly dividend, and it's backed by commercial real estate, right? So we do that, but that's a stock. It could go up and down. The company can choose not to pay the dividend.
Yep.
But no matter what, we still have our cash value in there that's always compounding.
Yep. So to go back to that a little bit there are certain criteria that I tell people of what makes a great policy for IBC. And there's criteria that we look at. And so a lot of people ask, well, what's the safety of this and those type of things? And so what I tell people is for us to use a particular insurance carrier, they had to have been in business for at least 100 years. Okay. They have to be a mutual insurance company, meaning that if you take a policy with that particular carrier, now you become a part owner in that insurance company. That's what pays the dividends and all those type of things. And then 2, they have had to have been profitable every single one of those years or paid a dividend every single year they've been in business. If they don't hit those 3, we don't use them as a carrier. So that gives you a little bit of how safe life insurance is. Another question a lot of people have is, well, and I think a lot of it is because we've been sold since the 1960s. Life insurance has been around for a couple hundred years. Okay.
And it
They're very
predates the
safe.
tax code.
Oh my goodness. Yes. And so extremely safe. And it's because of the things that we've been saving money in over the last, what is that now? 40, 60, 70 years or so since Wall Street got a real big push and the government plans got started in the 70s and all that kind of stuff.
Yep.
And so what I tell people is, unlike a bank where they can go out and loan $1 out 10 times, just go Google fractional lending and it'll make your head burst. It makes me really, really
Fractional
upset.
reserve banking.
Yes.
It's a wonderful.
It's unbelievable. But an insurance carrier cannot issue $1 death benefit unless they have that sitting back in their reserves. Because there is a chance that once you take out a policy that you could pass away the next week.
Yeah.
And so they've got to, by law, they have to have that money already sitting in reserves. So when it comes to a savings vehicle, and that's what this is, there's nothing out there safer at all.
Yeah.
Because even if you had it underneath your mattress, your house could still catch on fire and that's completely gone. So I don't feel like there is a safer way for you to save your savings than in high cash value, properly structured high cash value life insurance.
All right. So something I want to talk to you about is, because remember, you're talking to an audience of real estate agents and everything like that. So as a real estate agent or an investor, what are, some of the key concepts of using the infinite banking system for their, banking system for their banking function?
Yeah. Well, so the biggest thing is going back to that opportunity cost and realizing the second that a dollar loses or you hand over that dollar, you're losing that opportunity cost.
Yeah.
And so for a lot of people, if it is saving up $50K, let's say within just a regular traditional savings account, you're going to take that $50, you're going to go out and put it in a down payment or maybe just outright go buy a house, for example. Or let's just say $100K. Over the last 3-4 years, you saved up $100K, you're going to go buy a property to go flip. Well, the second you take that money, what little interest the traditional bank is paying you,
because they pay a lot right
let's
now.
call it 1%. I mean, whatever it is. The second you take that money out, you've now interrupted the compounding interest that you would be earning with that $100K still sitting in the savings account.
Yeah.
We can still save up the same $100,000 if it takes a year or 3 years, 4 years, the same amount of time that it took you to put it in the savings account. You just run that into a whole life policy first in what's called a premium. Okay. You could look at this as a deposit if you're looking at it from a banking, but the insurance company calls that a premium. So what that does, it does a couple things. It buys a death benefit, of course, but because of the way we structure these policies with the PUA rider, it also gives you cash accessibility. Okay. To borrow against that 100K. But here's the biggest difference is that 100K is still inside the policy earning interest. You have just used it as leverage. All of us know how important leverage is in the real estate.
Oh, yeah.
I mean, everyone does that. Okay. If you're using a traditional bank, you're using leverage, all those type of things. And so we're just using that cash value as leverage to get a loan, no different than you would go get a loan from a traditional lender. But now you get those special terms, of course.
Yeah.
But here's the power of it is you're continuing to earn that compounding interest for the rest of your life on that 100,000. If you live another 10 years, another 20 years, another 60 years, you're going to have earned compounding interest and dividends on that 100K for the rest of your life.
And the cool thing is, I mean, you truly are acting like a bank does because, how does a bank make money? They're not in the business of depositing your money and holding it there in the bank. Mm-hmm. It goes back to the fractional reserve banking system, right? Yep. So let's say you give the bank $100 and they pay you that 1%, right? What are they going to do with it? They're going to lend out that money to somebody else because that $100 to them is a liability because they're paying you interest on it.
Exactly.
So they'll pay you $1 for a year, and that's the cost of them holding on to that money, right? And then they'll loan it out to somebody for, let's say, $5, right? And, or 5% interest, right? And so most people look at that and they say, well, the bank made 4%.
No, they did not.
They did not. This is why banks have beautiful buildings.
There's a reason why they have the biggest buildings in town, for sure.
So the way you calculate rate of return is how much money did you make divided by how much did it cost. Right? And so they made 5. And it cost them 1. Right? So that's a 500% rate of return.
Exactly.
Not 5%. 500%.
Exactly.
Right? And all they did is use somebody else's money. We in real estate love OPM, other people's money, right? Especially investors. So they use other people's money and they lend it out and charge a higher rate of return.
Exactly.
And then they keep the difference, right? That's banking arbitrage, right? If you don't know that term, just go look it up. When Nixon took us off the gold standard, that's what created this whole system, right? And you can either complain about it or you can do what they do and use the policy to do the same thing. So if I'm looking at, an investment and I got $50,000 sitting over there, the cost of money, because remember, I'm borrowing the life insurance company's money, the cost for my policy is 4%, right? So let's just go back to 100,000. So if I take out a policy loan for 100,000, it's going to cost me $4,000 a year in interest, right? But my goal is to go actually put that money into an investment that's going to spin off a monthly income and then pay my policy back, through using my own banking function. And if I was to borrow that from a bank, I'd be making payments to the bank. So I'm charging myself, let's say, 8% interest, right? So I'm paying 4, but I'm making 8 from my investment, and I'm just paying it back. I am making a 200% rate of return. So that's what.
Plus, your money's still inside your policy, earning a return as well.
Absolutely.
So it's easy to forget about that, but that's what's also is happening. But you're paying that 4% interest if you have that 100,000 out for the entire year.
That's true.
So, for example, I have clients that are investors and they do flips. Okay, so let's say you access that 100K, and you're going to go buy a house for 50, put another 20 in it. And just to be safe, you go ahead and borrow the full 100. Well, if you only use that for 90 days, the 4% divided by 365, you can do that math there in terms of days. Don't quote me on this, but I think it's like $986.
Yeah, it's like
what you would pay in interest
because it's a quarter of the year.
Let's call it $1,000.
There you go.
That you borrowed that for the 90 days to access that 100K. Well, my hope is you would make more than $1,000 on a 100K by flipping this house. So let's say if you, went and with rehab and all that, and then went and sold the house for $125 or $130 or whatever it is. Okay, you're ready to pay that entire loan back, but you don't have to make a single payment for that 90 days if you don't choose to.
That's true.
You're going to have the interest earned accumulated during those 90 days though, which is $1,000. Okay, so let's say you don't have another place to put all that funding. You're waiting for your next opportunity, whatever it is. Okay, well, pay the loan back, pay back the full 100, pay the $1,000 in interest, keep the remaining profit. Now, this is where, as you're building out your wealth system, you could say, well, okay, I need to live off of, 10K of that or 20K of that over the next few months or whatever it is. But now I've got this other sliver of funds. What can I do with that? Well, we can start an additional policy, for example.
And that's exactly what we did.
So many different things that we can do with this funding at that point.
I remember the conversation because we took out some policy loans for some business investments and everything that have done really good for us. And we're making, our payments back just like we would to the bank and all this kind of stuff. And I came to you and I said, hey, I have this much out in policy loans that basically I could refill my bucket, right? My cash value bucket, right? And pay that back because I got all this extra income. We've had some really good months in real estate sales and everything. So should I pay that back or should I look at expanding my banking system and start building out more and more buckets by different policies. And we end up going with starting a policy on my wife. We got policy on all 3 kids. And then we eventually got another policy on me. So we have 6 policies out right now that we pay on a monthly basis. And I'll just be honest, for those that hear that, think, how in the world, that would scare the crap out of me. It does. When the middle of the month comes along and all our policy premiums that we fund these things with are come due, I mean, we have quite a bit of money going out every month. But one thing that we've really learned to appreciate is it's not another like a payment like a car or house payment. It is literally, because of the way we structured these, a majority of the cash that goes into these policies is cash value right away. Right? A very small portion goes to a death benefit. And you have to have a death benefit in whole life where it's not insurance and it qualifies as an investment vehicle and all that.
And we can get down that rabbit hole too. But that's something I have conversations with clients as we build things out.
I didn't struggle with it as much as Ashton, but now she's come around and she likes, I track it every month. This is our cash value and this is what we've done. And I could tell you from the very start what kind of cash value we had and watching that grow. And then we see, okay, we took out policy loan to go invest in this. And now we have more passive income coming in because of that. Right. And it's kind of cool watching everything kind of work together, and you really get pretty excited every month when it comes to, I don't like the 15th of the month, but I love the 16th of the month. Because the 15th we make our premium payments and but then, or the 15th we make those payments. And then the 16th I'm checking the balances and seeing the new cash value and the new, and that's pretty cool.
And everything you focus on grows. So, that's one thing we slow down to teach our clients is, hey, we've got to put structure behind all of this. And so this is the way we're going to fund this thing. This is the way we're going to flow, all of that, and just teaching them that so they have control of every single the aspect of the whole banking function of their lives. And so once they start to realize that and see their wealth starting to grow, they get excited about it. And if anything, I have a lot of clients, similar to you guys, anytime I have a conversation with a client and they're like, man, I just don't know, that seems maybe a little high in terms of what we're saving or what our premium is. I'm like, okay, well, let's just cut it in half. Let's get our feet wet. Let's grow this thing. But usually a lot of people will call in about 6 months or something and say, oh, hey, what you told me was true. I actually have cash value. I actually have been using this. I really wish I would have started this, with a higher premium or whatever it is. Okay, well, great. But we can do that now. Now that you see how the system works and how we build this thing out, then let's have a conversation then what that looks like to build out an additional policy.
Absolutely.
For a lot of people too, though, it's all about each individual client. So for some people, we need to set a premium and looking down, 10 or 15 years down the line. So for like some of my business owners, let's say they have a business that's worth $10 million, or their plan is to sell that for $10 million. And they're not going to do that for another 10 years, for example. Well, what are they going to do with that windfall here in 10 years? Just sit on $10 million in cash sitting somewhere? So for some clients, it just depends. Where we create this banking function, allow them to start depositing, using the cash as leverage, create a bucket for here in 10 years when that business sells, that they have a place for that cash to go and be able to pay back policy loans or all those type of things. But over the course of time, we created a bucket and compounding interest on the side of that bucket, and that's the natural place for that to go. So it's, each individual client's different. Some buckets need to be bigger than others depending on what their thought process is in that line. So you need to find an agent that does this, understands what your long-term goals are and things like that, to really specialize this for each individual. And that's why I love why I really like using the infinite banking concept, because it is infinite on the ways that you can use this. And I love entrepreneurs and I love investors because they'll call me and say, hey, can I do this with this? Yeah, you can. I never thought of that yet, and so this is how we structure it. This is how we move the money in and out and all that. And so, that's why I like dealing with investors. And because they're the entrepreneurs, they're the thought process behind all of this, but it is infinitely the way that you can structure this.
For sure. And, the cool thing is, our oldest is 12. We have a policy out on her. Well, we have a policy on all 3 kids, but, I'm able to walk through the illustration and show her, hey, this is a cash value that we're building in your policy. And we're setting stuff up to where, okay, for one, she, even at 12 years old, 50% of everything that she makes, whether she gets money from grandma or grandpa, everything, it's got to go into some asset, right?
That's awesome.
So my 12-year-old is making $18 a month passively, right? And we're tracking that. And every month we do a report and she sees that. And that doesn't sound like a whole lot, to a lot of people, but she's 12.
Yep.
And, so our goal is by the time she's 16, we can use the cash value in her policy to buy her a car, right? She is then paying for that car out of her investment income that comes in passively.
Yep.
And she's not strapped to a bank, and having to play the FICO score game all her life, right?
Yep.
She's created that banking system.
Yep.
And then she'll just pay it back. She'll pay the policy loan back with her passive income, right? And then hopefully she still does the 50% thing. We strive to do that ourselves. And I actually learned that from Shaquille O'Neal.
Oh, yeah?
Yeah. Okay. So it was a short little 1-minute interview. And he said, hey, if you want to be rich, take $1, split it in half, put this half into investments, this half, you can do what you want. If you want to be wealthy, take that half, that you're spending, split it in half. Now you got 75%, the other 25% ball out.
Yeah. He's done pretty well for himself.
I mean,
post-career, for sure.
He's done good financially. So, but that's where the concept comes. So we didn't start there, and we're not quite at 50%, but we're doing good, and then we're teaching our kids. Hopefully, they just take that and run with it. And then with these policies, I mean, I can only imagine what they, So we have a plan for them to buy a car at 16, and then hopefully have that policy loan paid back, and then when they're 21. They'll go buy their first, hopefully a duplex, and they'll have a duplex that they can live in, and they rent out, and they're paying themselves back. So, that's kind of the plan that we have for them. That's on the very surface level of generational wealth building, but that's what we intend to do with it. So let's talk about if I was to fund this, using this method. Like we said, it's not your typical whole life policy, and that's one of the things I want to mention about you is, you're basically funding two different things. You're funding the death benefit portion, right? That's your insurance. And then you have your paid up additions or your cash, right? And, some people go very high cash and very low on the insurance and everything. And, but there's this in between, right? There's kind of I think we did like 70% cash, 30% death benefit, all that kind of stuff. And the thing that you told me is you make more money on the insurance portion.
Well, that's the only way that an agent gets paid.
Yeah.
Is off the base death or the base portion of the premium.
And so these policies that you're even suggesting for me and all your other clients, you're not getting paid like a traditional agent does who sells 100% whole life. I mean, but you're helping them build wealth, which is what I really appreciated about you is you didn't look out for your own interests, but instead trying to help as many people build wealth. I mean, you got 6 policies just for my family alone off that. But the cash value portion, how soon can I access that cash value? I mean, do I have to wait like a year before I can access that cash value, or what's that look like?
Yeah, so it depends on the carrier, but typically I tell people, because I always want to over deliver, but I tell people, plan on 7 to 10 business days. Some carriers are less, depending on the nuances of each carrier, but there's a process. So first you have to apply for the insurance, have to get approved. You make your first premium payment or your first deposit into your bank. At that point, I would say 7 to 10 business days, it's available to you once you put $1 into that. So, 7 to 10 days.
So it's not like locked up forever.
No, it is not. Yeah. So that's a misconception that I get is liquidity issues and such. It's pretty darn liquid. But I'll be honest too. A couple of our carriers are just within a few hours drive of us right now in Wichita, Kansas. So, one of the carriers that I have policies with personally is up in Lincoln, Nebraska. Okay. So if I just absolutely needed the cash today, I could drive 5 hours and have a check.
Same day.
So same day. I mean, just drive up there and say, hey, I need a check. This is the other thing too. Is so when we're talking about loans and all that, is there's two questions I get, and I'm sure you've answered the same two questions, is how much and where do you want it sent?
They don't pull your credit?
No. So this is another thing too for like investors and let's be honest, from a traditional bank, there's only so much they're willing to loan you.
Yeah.
Based on your income, debt ratio, all those type of things. If you've built up the cash value, they cannot say no. You have first right to that cash value inside that whole life policy. So for a lot of people, as they're building this up, you're not going to be able to just jump in and take over all the financing inside your business within the first month.
Yeah.
That's not going to happen. So you're going to have to use traditional banking for a while. But eventually, the thought is to use that system less and less, every year in and year out, less and less, less and less, less and less.
And when you say traditional banking, what we're talking about is the lending aspect.
Yeah.
Right. We're not talking about everyday purchases, food, and all that
No.
debit type stuff.
And so that's another thing too. There's people out there, there's talking heads now because it's gotten so popular that they'll say is, yeah, your utilities, your cable bill, like your day-to-day living expenses, run it all through whole life. That makes absolutely no sense. And I would say run away from those people.
Because you're paying
interest on your cable.
Yeah. Why would you do that?
Why would you do that? No, this is systematic savings on the side. What amount are we willing to save that you're already saving? So we're not taking more cash flow away. What are you already setting aside for investments or that you want to start for investing and use that dollar amount to get the benefit?
Yeah.
So, yeah, I mean, we still have a savings account. We still have a checking account. But when it comes to our savings, our investments, everything runs through whole life first. And that's money that we've set aside. Like you said, you had your percentage on the side that goes out every single day. And that's just an opportunity fund.
Yeah.
That's what we're talking about.
Yeah. This is long-term wealth building, and again, the policy is not an investment. It's just where I store my cash that I'm saving up to then go put into an investment vehicle somewhere down the road, which is another thing that I think Dave Ramsey gets wrong. He when he does the calculations, it's a horrible investment. Yeah. Well, yeah, I agree with you, Dave, because it's not an investment.
Yeah, and it's funny. So I wrote a real quick ebook. And so when my wife read it, she goes, is Dave Ramsey going to come after us? And I said, well, no, one, because I'm a little fish, compared to Dave. But I said, either he has not educated himself, and I hope that's the case in terms of how whole life really works, how term really works, all those things. I hope he just hasn't educated himself. If not, he's outright lying to people.
Yeah.
He's outright lying to people the way things work. And
well,
so I hope that's not the case.
I think he's built a really good product, right? I mean, when you look at, because Dave Ramsey and I actually have similar stories. He lost a lot of money, went bankrupt.
Yep.
In 2008, I lost a lot of money and a lot of properties and went bankrupt. And, one thing that he did is he started learning about basic financial principles. And for the most part, they're good.
Yep.
I have no problem with, being or staying below your means, live on less than you make, save for retirement, that kind of stuff, put it back for investments. I just don't like the vehicles that he chooses. I like control, right? He wants you to go put your money into a mutual fund and everything and give up control for 40 years, right? I'm not okay with that from a personal. I would rather bet on myself, know that if I go put money into an investment, it's more of a, Rich Dad, Poor Dad, Robert Kiyosaki type thing. I want the cash flow from that investment that then pays for my lifestyle, right? I
think, unfortunately, a lot of people think, well, if I follow Dave's advice, I'll get to where Dave is.
And that's not how he got it.
That is not how he got to where he's at. He's a business owner. He has built a business. He's an amazing marketer. That's how he's built his wealth. It's not by following his own advice. Now, I tell everybody, yes, you follow his advice. That's to get you to ground floor.
Correct.
But to build long-term wealth, that's when you stop following his advice in terms of the mutual funds and all those type of things. Now, there can be an avenue to save in those type of things and everything that you do there, but you also need to realize why he's marketing those things and pushing those things, because he also benefits from you using those.
From the ELPs.
Exactly.
Endorsed local providers that he takes a percentage
of. You need
of.
to understand that.
In real estate, when I first started, I worked for a team, and that team was an endorsed local provider. Ironically, that team leader that was the endorsed local provider never been through a Dave Ramsey event, never read one of his books or anything like that. I actually had lunch with Dave Ramsey, a year before that. So
I don't know if I knew that.
Yeah, this is back in 2010.
Okay.
I had lunch with him down in Orlando, all that kind of stuff. We paid extra money, obviously, to do that. But so I knew all about Dave Ramsey, and so I would work all the real estate endorsed local provider leads because I could actually have conversations with these people. But every commission check that we got, we had to pay Dave Ramsey 27%. Out of that commission. So he gets paid a lot of money from his endorsed local providers for his stuff. Now he talks a lot of, buy term, invest the rest, but I saw a statistic the other day, 98% of term policies don't even pay out because they expire.
Yeah.
So, I heard this as well, the only life insurance policy that matters is the policy that's intact the day you die.
Yep.
Right?
Yep.
And so do I have term? Yes, I have some that I've bought a long time ago, and there's no sense in me getting rid of it.
Yep.
All right? It's cheap, and it gives an extra layer of protection for my family.
Yep.
But it is not, we understand that we are renting insurance at that point. And I hope that I'm still alive when that thing expires.
Yep.
But I know on my whole life policies, it's guaranteed to pay out.
Yep.
It's with me for the rest of my life.
Yep. Yep.
So
when we went back to the insurance company paying you dividend and the profits that they earn, a lot of that profit is from the term insurance that they're writing.
That's funny.
I mean, it's just being honest. So, because it's 98% of the time they don't pay out on those policies.
Yeah.
And I think there's a misconception too for a lot of people is saying, well, term is so much cheaper and those type of things. Well, per dollar of death benefit in that set term, yes. But if you wanted that same coverage for the rest of your life, you're actually going to pay more over the course of your lifetime for term life insurance than you are whole life insurance.
Because the older you get, the more expensive term gets.
And it's more likely they're going to pay out within that 10-year term or 20-year term or whatever it is. So I've had a lot of clients, before they come to me, they have term policies. And they'll say, hey, can you quote me on this? My term policy is about up, or 4 years or whatever. And I give them that new quote. And they're like, well, I can't afford that. And so they're caught off guard all the time. And whether or not they've been told those things, I really don't know. But that's something you need to understand, as you go talk to a life insurance agent. I have term as well, because let's be honest, I'm the youngest I am today. I'm the healthiest I'm ever going to be today compared to tomorrow.
And you remind me that you're younger than me.
I am. And so, but I get a preferred plus rating. And the opportunity for me to have a preferred choice rating in 20 years is much less than right now. But it's a convertible term, so I can lock that rating in for the next 20 years and decide I would like to turn this into a whole life policy 20 years from now.
Gotcha.
And so, it's each individual client's different. But for me we'll buy a whole life policy, buy term policy. Whole life and term. And just stair step this until our whole life coverage is where we want it.
Yeah.
And ultimately, I don't know if we'll ever get there.
Yeah. The cool thing about my policy is it stays the same forever. And honestly, after 10 years, the way we've set them up, they actually go down. And I quit paying a lot of the PUA, the additional, and I've fully funded for the most part, and I'm just paying the base premium. So here in the next 7-8 years, my overall monthly payout is going to be substantially less, but I still have the cash value building.
Yep. I mean, my goal is to continue to buy policies. I know you have 6. Nelson Nash, at the time he passed away, owned 49 policies. And so, that would be eventually what I would love to build out and this is, we haven't even talked about death benefit. And at the time of your passing, that wealth transfer that will happen for your kids, you've got policies on your kids, now for your grandkids. And so that's how the Rockefellers have built what they've built. And why you hear about the Rockefellers, you still hear about the Vanderbilts, but why they have no family wealth passed on from generation to generation is the way that they've structured everything. And so the Vanderbilts, within 3 generations, have spent all of their money. The Rockefellers, just working like a machine. And it's because of using this concept.
All right, buddy. So somebody new to this whole concept? Like, what should be their first steps? What should they be looking for in a policy? What should they be looking for in an agent that'll help them? Could you help them, nationwide, whatever?
Yep.
Go into that.
Yep. Well, so first of all, for somebody wanting to get started, they've got to make the decision that they're not happy with the results they're getting. They're willing to look at something different. Is probably the first key, that they want some change from where they're at. At that point, finding an agent that practices in this avenue, in this space. And there's a small number of agents that work in the infinite banking concept. It's just being honest with people. So you want to find an agent as you start asking questions that understand what a modified endowment contract is, that maybe actually use their policies and actually have helped clients, because it's amazing how many insurance agents maybe don't know how to actually pull a policy loan and initiate that.
The crazy thing that when you say that, a lot of these insurance companies don't even know what infinite banking system or concept is.
Yep.
They don't even know anything about IBC, and they've been selling this stuff for over 100 years.
Yep.
So it is literally a concept that you put in practice.
Yep. So life insurance, whole life insurance has been around for 200 years, let's say. But this concept, when Nelson Nash I would tell you, read the book. This concept came about in the early 1980s. And so we can get into that later if you want, on how that whole concept came together. But really, it's still kind of a newer type of a concept. The insurance companies have been around forever. The concept, not so much.
Yeah.
So as our firm has grown, as our client base has grown, and I pride ourselves on this, we actually have been working alongside of insurance companies, helping them build out their structure. And I know we've talked about that, but helping them build out the structure for them to understand what the opportunity is for them to even grow their carrier base by using this concept.
Yeah.
And so, you need to have an agent that understands, what it looks like to pull a loan, how to set up policy repayments. If you want that automatically, that's what you need to find, is that agent. And so it's by asking a few questions. And if anybody had questions like, well, what should I ask? If I want to use my cousin, what questions should I ask him to see if he's even the one? And start from there, for sure.
Yeah, definitely. It's just like anything else, man. I don't want people that just have the head knowledge. I want people that have actually done it. That's what I loved about you. And you guided me through the whole thing. And then I remember it was like a light bulb. It's like, boom. Oh, okay. This is what I can do to this. And then, or do with this. And then I started just doing all kinds of research, come to you like, hey, can we do that? And then you're like, well, I've never thought of that,
Yep.
And so when you said that earlier in the show, I was like, I was one of those that, but it's cool when that light bulb actually goes off. And then I've sent people your way that are clients of mine from real estate.
Yep.
And now they're using their policies to take out and put as down payments for investment properties and everything like that.
Yep.
And we're structuring when they get rent from that, then they start paying back their policy loan and everything like that. So this is something that's really helping my clients, through something that you got me started on. So it's a compound effect, and I'm really excited about that.
Yeah. One thing too, going back to looking at an agent or finding a correct policy and things like that, is you can look at, the amount of premium or the amount that I've deposited into the system, how much cash value and how quick do I actually have that accessibility? That's a quick check, I would say. And so my goal when I put together policies is when you put $1 in, you have more than $1 available to you to borrow against within 3 to 4 years. And that's an amazing policy that's set up for IBC.
Yeah.
But also I'll tell people is you'll have some agents that can go up the chain or whatever and illustrate a pretty good policy. And I'll get those a lot too on a comparison side and say, hey, this is the policy that they gave me. And because I'm non-captive, I can match every single one of those illustrations. So at that point, it comes down to who is it that you want to partner alongside and work with for the rest of your life.
Yeah.
And do you see me as somebody that is knowledgeable enough, that wants to work with you, that's willing to answer the phone? I mean, that's why I love this line of work too, is because in the market that we're in right now, in 2025, I don't know if a whole lot of people's CFPs are picking up the phone, to answer their clients. I mean, just being honest. And so for me, I love my yearly reviews, quarterly reviews, whatever it is because we can sit down and say, hey, this is what we illustrated. Here's where we're at. These are the reasons why we use these carriers because they actually perform the way that we illustrated. And so I personally love my yearly reviews. And so, they may be able to structure the policy or have the conversation with somebody or maybe listen to a podcast long enough to figure out how to structure it properly. But is this really the person you want to continue to? Because my goal is to never retire. And so, at the time of your passing, if I'm still here, am I the one that you want delivering the check, to your kids?
Yeah.
And fulfilling that contract of handing that to them. That's the way I look at this with every single one of my clients. And so you got to find an agent that's willing to do that and not say, this was the commission I made. That's just not going to work.
Yeah.
And that isn't how life insurance agents should look at this.
And we can look at real world like on mine. I'll throw it up here on the screen. We did an initial, because we did a $20,000, basically a dump. So
there's a lot of nuances into that too. You got to be very, very careful for tax consequences and all those type of things. So, as you're looking at your agent, you need to ask questions going back to that modified endowment contract. And so there's long-term tax consequences if this isn't done right.
I left that up to you.
Yep.
And I just knew that in the first year, my base or my premium that I was on the hook for was $30,000.
Yep.
So we have it set up on a monthly base, so $2,500 a month. Right. And then I had, anytime in that first 12 months, the opportunity to throw in $20,000 extra.
Yep.
And we wanted to do that because we wanted to fund our banking system and build, our Nelson Nash calls it the capitalization, right? You're capitalizing your banking system.
Yep.
And we wanted to get as much money in there as possible.
Yep.
And we had the money at the time. So we did that. And so, just to give some real world numbers, we put 50 in, and according to this, and I can go back and look at the actual numbers, but according to this illustration, and I know they change every day and all that kind of stuff, but we had 39,000 available.
Yep.
So typical person will look at that and be like, and this is where Dave Ramsey comes. Well, I put in 50 and I only got 39.
Yep.
That's horrible. I lost 11,000. No, you funded your banking system. And remember, not all of it is cash value.
Yes.
Because you have to buy insurance. And that's where people don't understand.
Yep.
But, that 11,000 bought me almost 1.2 million in death benefit.
Yes.
So if I was to die year one,
Yep.
I would have my family would have got a $1.2 million check.
That's a pretty good turnaround.
That's not a bad turnaround.
Yep.
Right. And so, and as we go, we're going on our fourth year in. So every year, the second year, the third year, and the fourth year, I'm just on the hook. I'm no longer doing the $20,000 dump and everything. So, I've funded 50, 80, 111, 140. Is that what it is? 140? I don't even know.
Yep.
Yeah, 140. And my cash value is about 126. So every year it gets a little bit more efficient. I get more and more.
Yep.
And so probably around year 5, year 6, I will be ahead of what I put in.
Well, and like, I mentioned earlier, and just looking at your numbers here, between years 4 and 5, you make another $30,000 premium payment or deposit. Your cash value grows by 32.
Yep.
That's my goal. And
and that's the cool thing. And we even went more death benefit.
Yep.
Right. Yep. And there's some strategies behind that as well.
It's whatever the individual client's preference is there.
And so at the time, 3 years ago, I was more concerned about if I'm no longer here, I want my family to be protected. So we went a little bit higher percentage of the death benefit than cash value. But the cool thing is I'm looking ahead and I'm looking in, let's say, retirement, right? So this is like a retirement to me. Now, I know there's some talking heads that's like, oh, don't use this as retirement. But it's a part of retirement, right? If I would
say to supplement.
It's a supplement, right?
Exactly.
That's a great word for it because I'm using some of this cash value to go buy cash flowing assets that are going to pay me in retirement. But I'm also looking at this, when I get down to year, 70, 71, and how old I am, right? Then I'm putting in only $9,500 a year, not $30,000 a year anymore, just $9,500. But if you look from year 70 to 71, that's $55,000.
In cash value growth.
in cash value growth.
Yep.
So I put in 9,500 and I'm getting 55,000 for that year.
Yep.
So I can essentially live off what? $45,000 a year just from this one policy?
Yeah, each individual policy, could perform different or better, or however you want to look at that for carriers. One thing, then we can get into this a little bit. So comparing that 39,000 available, and you put 50 in.
Mm-hmm.
So let's say you put 50 into your 401k.
Mm-hmm.
Yes, your account balance may say 50, but you've given up access to that until 59 and a half, and you cannot use those dollars ever again. It also has the opportunity to lose whatever it may be, depending on what the markets do over the next year. But also, let's say if you wanted to now withdraw those funds, if you decided 10 days after starting the account, hey, I want my money back. Well, if you're not 59 and a half, right off the start, that 50 is going to get cut to 45 because you have a 10% early withdrawal penalty. Okay. Plus, if this was a tax deferred account or delayed account is what I tell people, you're not deferring the tax. You're just delaying the tax until you're ready to access those funds.
Yep.
So let's say if you got the tax benefit and you put the 50 in and then took it off come April or however you do your taxes in March or whatever, now you have to also take tax out of that remaining 45. So if your taxable income comes 25%, now you're cutting that 50 again by another 25%.
Yep.
And you're below the 39 that you had access in your whole life policy. So you can't you got to compare,
True
apples to apples, not apples to oranges, and how all this works. So, you need to take everything. And that's what I love doing is showing people, hey, if you want to go this route, let's crunch the numbers. Here's the pros and cons or the consequences of making this financial decision. But if we go this route, here's the pros and here's the cons and the consequences of this decision.
Yep.
So, yeah, you can't, but that's what I see Dave doing a lot is those type of comparisons, but not giving the full picture and saying, well, yeah, if you put it over here in the mutual fund, plus you're not paying a management fee year in and year out on this.
Nope.
And so I feel like I'm pretty upfront and honest. And if somebody asks me, well, what's your commission? I'm always happy to share my commission.
Yep.
But I'm not charging a 1% or 1.5% fee of that cash value every single month for managing your account.
Nope.
So you just got to take all aspects in and then make the decision that's best for you.
Absolutely.
Yep.
The great thing I love about it is that money is protected. So I know once I put it in there, if I get sued, if I get into a car accident, I get sued, it's off limits.
Yep.
Because it's not my money. The way the law looks at it, it's not my money anymore. Because to access that money, I have to borrow against it from the insurance company. So I love that protection. So if I had that in a 401k, that's open to litigation.
Yep. Now there are some nuances. I mean, your business could own an insurance policy. I mean, that's advanced planning. And that's another reason why you want to find a particular agent, that has the network and can help you with all those aspects too. And that's a big part of this also. But yeah, there's all kinds of different types of policies, personally owned, business owned. I mean, that's all really deep dive in strategies that we can put together too for people.
So before we go, I want to talk about this because we have 6 different policies that we've got now since starting 3 years ago. I love the fact that we have 6 policies. I can't wait to get the 7th policy. Why would someone want to get multiple policies like that?
Well, I think our need for financing is never going to go away. And with the way our dollar goes, it's going to cost you more and more to live the longer and longer you're around. And so you need to continue to increase that financing availability for yourself. And so my goal with all my clients is if they start using this system properly, they should be starting to earn more income, whether that's passively or actively, whatever it is. And so naturally, you need to be a good banker and continue to take a portion of those funds and save them off to the side to just grow, if that's your thought process, is to grow that wealth and that bucket that you're providing for yourself. And so let's say, you have that $100,000, you turn it into a cash flowing asset, you decide to pay back $600, $700 a month into that original loan. Well, now you've got $400 to $300 in passive cash flow on a monthly basis. Well, I look at that as that's another $3,600, $4,800 a year that if you're not having to live off of that you can automatically fund another policy, gain access to that cash, get additional death benefit protection for your family, and then access that cash to put into the next real estate deal. Now, what people are doing now is they'll, sit that over into a savings account, save up another 20, 30, 40,000, whatever it may be, and then put it into the next property. Well, all we're doing is we're adding one additional step and just running it through an insurance policy first. And so that's my goal, is to eventually help you build this out to a point where you're able to take over the entire bank function of your life.
Yeah.
We still have a mortgage with a traditional bank. But other than that, everything we finance, if it's vehicle purchases, the same thing, instead of 529 plans, all of that, our kids, if they choose to go to college, I'm not by any means going to force them to go to college. You and I think the same way
on that.
And so, but this is the thing too, there's a lot of parents that are putting money away in 529s right now. There's nuances with that. That's another government plan. They've got full control on it, on secondary education.
Yep.
And if they don't go to college, like I said, my kids, if they don't, as long as they're a productive member of society, have a way to support themselves, whatever, go for it. And if it's something you love and can bring value, go for it. But we're not going to be strapped for what we can use those funds for. The funds will never go backwards like it can in a 529 plan. I mean, all those different things. So everything we fund is through cash value life insurance.
Yeah.
And so my goal eventually is, to be able to purchase and take over home mortgages. Everything will be financed. Now, for some people, maybe you never want to completely get away, but a lot of my investors right now, they're not getting 4% loans on their investment properties right now.
Especially hard money lending, you're talking 12%.
Yep. And so right 15%. Now, my investors that have been doing this for a time such as this are loving the fact that they don't have to go get an 8% loan, 8.5%, or if they're wanting to start a business, go get a 10% loan, whatever it may be from a traditional bank. They've been storing cash up here. They're borrowing at 4%. And then who knows, they could go refinance those properties or whatever. If I don't know if interest rates will ever go down to where they were.
I don't see them going down to
not anytime soon.
Not anytime soon.
So if that ever happens, fine. Go to a traditional bank, refinance your home, and then put the cash value and pay off the life insurance loans.
For sure.
I mean, it just gives you so many different options.
Yeah.
So
our whole concept of what we're trying to achieve with this is we want a place to store money, right? And so with every policy, our bucket gets bigger, that we can store more and more money.
Yep.
And then we want to take that money and go buy cash flowing assets that pay us every month or quarterly, and use that money to pay for our policies, right? And then on top of that, our living expenses. So eventually we want to use our cash flowing assets to pay for all our lifestyle and everything, be financially free, but it's also paying for these policies. And then once we get to that, then we'll continue to grow our money a little bit more until we have enough to go buy another policy. I want to get to a point where all our passive income is paying for the policies, which only increases, our cash value that we can build. It increases our death benefits. That goes back to a trust, right? And the beneficiary is a trust, so it's not taxed, and everything like that. It's just, there's so many benefits of what you could do to this. So I'm really excited. Any last things that you want to say before we go? Well, how can people get a hold of you? I'm going to put your information down in the show notes. Yeah. But, should they email you? Should they call you? Or what? Is there a website? You want me to just put your website down there?
That's fine. I tell everybody I'll communicate the way you want to communicate. So if you want to text, we can text. If you want to email, we can email. Phone call. I love hearing people's voices. But probably the easiest way would be wealthwithoutstress.com. His website. I've got my ebook on there. Some of the other ways that I help people, some client testimonials on there.
You got a great newsletter.
I'm fine with, you can subscribe to my weekly newsletter. I just try to throw out anything kind of financial when it comes to those things. And I try to be pretty relevant with what's going on. My cell phone's 316-619-7679. You're welcome to, shoot a text with your name and we'll find a time. And I always tell people if I don't get with you right away, I'm probably with my family or with a client. Yeah. Other than that, I'm pretty receptive
Yeah.
of getting with you pretty darn quick. So
No, you have been with us, so I greatly appreciate it.
yeah.
Well, Jason, thanks for coming in. I really appreciate this. Like I said, if this is your first time on the podcast and seeing the content, it's not your typical new agent jumpstart stuff, but this is so important, guys. My wealth did not take off the way it did until I started implementing this system and the infinite banking concept. So it's a game changer for your life. It's a forced savings program is how I see it. And then if you use that and you put it into investments, it can just do wonderful things for you. So if you found this information helpful, please do me a favor, hit the like button and subscribe to the channel. Love to have new followers, and feel free to reach out. And please reach out to Jason with any questions that you have about this. He truly is the expert, and it's the reason why I wanted you to come on. So it felt so important that I had to share this, because this is something that looking back, I regret. 10 years of my career and I didn't have any of this. I would be so much further along had we started this 10 years ago. So I know you weren't even starting it 10 years ago, but whatever.
Yep.
But yeah, so thanks again. And until next time, we'll see you.